Good afternoon and welcome to this week's BizSmart Lunch and Learn webinar. Thank you for joining us this afternoon. Our weekly webinars are aimed to provide advice and share knowledge on key business topics and specialist areas. And joining me today is Simon Cook, who will talk to us about the budget and what it means for your business. Before we start our webinar, can I ask you all to use the question mark function on your screen to post any questions that you may have for Simon, and he will do his best to answer them all at the end of the session. Okay, thank you, Simon. Over to you.
Okay, thank you, Caroline. Good afternoon, everyone, and thank you for logging into this exciting seminar I know you're all waiting to hear about. This is basically about the budget. A lot of you will probably know some of the things announced, some of you may not. What I've tried to do is summarise some of the key points for individuals and businesses. There's probably a lot that I could have covered, but it could have took a whole day. So hopefully I'll cover mostly what's relevant for you and you business owners. So I will commence. So first screen, as you can see, the budget, what does it mean for you and your business? Well, as you know, I'll introduce myself again. I'm Simon Cook and I'm from SRC Accountancy Services. Just so you know, we're based over in King Swinford in the West Midlands. I've got an office of 4 or 5 staff there, and I'm the director with 15 years experience. So to start off on a positive note, our economy in Britain at the moment is still continuing to grow. The government in this Parliament are adamant on cutting the national deficit. So not only do they have the growth, there will be a lot of spending cuts. You can see that I've made the point that probably one of the biggest cuts will be most likely the NHS. And also you've probably heard in the news there's going to be a lot of benefits that are going to be shortlisted as well. I think the government aims within the next 4 years to be out of a deficit and into being a surplus. So for businesses, it's good news. The economy is growing, steady, not outstanding, but steady, good growth. And I think, you know, for all good functioning businesses, plenty of opportunities out there. But from a personal perspective, again, your NHS waiting list might get a bit longer. Right, so what's been announced in the tax thresholds? So just to explain, personal allowance has been increased. So the personal allowance is the amount of income you as an individual can earn before you start paying any tax. Now, from the 6th of April, which is from tomorrow, your personal allowance will go up to £11,000 per annum, and they are looking to rise it again this time next year to £11,500. They've also increased the point in which you'll become a high rate taxpayer. As of from tomorrow, that will go up to £43,000 before you pay the 40% slice of tax, and the year after that, £45,000. And for anyone you lucky enough to earn more than £150,000 a year, the 45% tax rate remains. I just wanted to clarify on this point. There is a lot of confusion amongst people on what that 43 and 45 means, and that actually already takes into account your 11,000. So if you were earning a job £11,000 per year, for example, then you'd have to knock that off the 43, which would give you 32 left to earn before you get into higher rate. So the point to note is the 43 and 45 already include that allowance. Right, this is a big change for a lot of businesses, especially smaller limited companies, the dividends tax. So I can imagine there's a lot of businesses out there where we have directors who run the limited companies on a minimum salary and take out dividends as the rest of their, in effect, wages. The taxman's onto this. He realises that the people are using it for a lot of avoidance of national insurance. So what they've decided to do is, although limited companies pay corporation tax, the money received as a dividend now will not be treated as taxed at source. So basically what this means is that as an individual, if you have a dividend out of your limited company, if you're in the basic rate tax band, you're going to have to pay 7.5% personal tax on your personal tax return. However, he has indicated that the first 5,000 you received in dividends will be tax-free. So may I suggest any people that are in this situation that have partners who are not using up the dividend allowance, i.e. they just have a job, for instance, might be a good time to transfer some shares, because transfer between spouses is not subject to capital gains. So give some shares to your partner and use their 5,000 allowance as well. If you're a higher rate taxpayer and you're in the top slice, it doesn't really affect you because the rate will still be 32.5. But basically this 7.5% will affect quite a lot of small business owners. So expect personal tax bills where you haven't in the past. Okay, just from this budget, my feeling is that unfortunately landlords and investors were the big target. It's been in the press a lot about landlords not being happy with all the changes. Now, one of the big changes that's been talked about that's being brought in is that if you rent out a property, a second property, in the past what you would do is on your tax return you would put in the income that you get from the rent, and then you'd be able to claim your interest back that you paid on the mortgage. If you're a high rate taxpayer, over the next 4 years they're only going to be able to let you claim half of that. So what that basically means is if you're a basic rate taxpayer and you have a second property, it won't affect you. It's mainly targeted at more like landlords that own 4, 5, 6 properties that, you know, from their income or profit, should I say, from their rentals, if it puts them in the higher rate, they're going to be strongly affected because, you know, it's just going to put their tax bills up massively. My fear with this is that it might hike up rents. So people that are already struggling, that are probably renting, that can't get on the market, the government probably need to take into account the fact that, you know, naturally the landlords are going to have to recuperate that somehow. So it could be an increase in rent, which is really counterproductive, because the idea of doing this was to stop people investing in properties and let new buyers get on the market. So, you know, it's a bit of a catch-22 there. So just to give you an example of how that might work. So I've given you an example, just a made-up person, little picture of Mike down there. He's a high rate taxpayer and rents out a property for £12,000 a year. And from that property, he has a mortgage of which he pays interest of £5,000. So his profit on his tax return would have been £7,000, and then he would pay his 40% tax. Under the new regime, Mike would only be able to claim, that should say claim 2,500 of that 5,000 interest, and which basically means that he's going to pay another 2,500 at 40%. So landlords with lots and lots of properties are going to get stung under this regime. One of the rumours and things that people might be looking at is, if you're a landlord investor, is moving all of your properties, if you can, into a limited company, just so you can pay the flat 20% corporation tax. So as I say, landlords are a bit of a target, and you'll see why later. Capital gains tax cut, but in brackets, not on the sale of properties. So if you're a property investor, unfortunately, if you sell your property and make a gain, you're not going to benefit from this capital gains tax cut. So the cuts are that at the moment 28% is the higher rate tax for capital gains tax, and 18% for basic rate taxpayer. The good news is that the rate has been slashed to 20% and 10%. The people that this will probably benefit from the most are people that have bought shares in public companies who have sold them for a gain. Those are really mainly the people you deal with, other than properties that would see capital gains. So again, property investors seem to be a bit of a target on this budget. Some good news, I know it's not a lot, but it all adds up. Corporation tax currently 20%. From next year they're set to reduce it to 19%, and hopefully by 2020 it's going to be cut down to 17%. Now, where the government has got the money from this from, I feel, is probably the dividend tax. So where they're taxing the directors now for taking dividends out your company, they're going to reduce the corporation tax slightly. If you're self-employed, anyone that might be self-employed or know anyone who is self-employed, if you're paying what used to be the old version of stamp or your £10, £12 NICO contributions, the government are going to scrap that, which I'm glad. It's a bit of a waste of time, a bit of an administrative burden for the sake of it. So from 2018, you're going to be £120, £130 a year better off. So a little bit of good news for the self-employed. Just a few other items I just wanted to run over. The stamp duty. So from the 16th of March, again, if you're a property investor or you have a second property, if you are looking at buying any other investment properties or buying a second home, they're going to put an extra 3% levy stamp duty on the normal rates. So just to give you an example, I'm just going to get the rates up that I've got here in front of me. Just give me a second. So where in the past, if you bought a property below 125,000, you'd pay 0 stamp duty, but if this is on a buy-to-let or second home, you will pay 3%. Up to 250,000 was 2%, will now be 5%, and then above 250 to 925 was 5%, and now will be 8%. So all of you people that are looking at buying your second, third or fourth home as either an investment or any other reason, you're going to pay the extra stamp duty that's been introduced. There's some other good news for small businesses. The rates relief for business, that's going to be increased from 6,000 up to 15,000. So a lot of small businesses that might be paying rates at the moment, get in contact with your local council, because if you're small and you think that you shouldn't be paying it, you need to contact them to see how the new rates relief might get you free rates on your business basically. I think I've covered the key important points. There was one more thing I wanted to mention, but I forgot what it was. So sorry about that. Let's see if anyone's got any questions.
Let's have a look on questions. Andy, brilliant, thank you. You've sent a question on dividends. Is it correct that as long as the company declares the dividend before the 5th of April, then the new rules won't apply, even though the directors receive the payment after the 6th of April?
Absolutely correct, Andy. So it's all down to when the dividend has been voted. So anybody that has year-end accounts that don't fall in with the tax year-end, i.e. let's say December, you can take dividends after that and just get your accountant to vote them at the 5th of April. So you would be looking at your accountant to maximise the amount of dividends, even though you haven't taken them, to vote them so you can draw on them later. So for example, if you had a company whereby you'd taken a 10,000 salary and 15 in dividends, I'd be looking at voting another 15 in dividends, just basically to save for future dates. So yes, Andy, something to keep an eye out for. Get as many dividends as you can voted on your personal tax return for the 5th of April 16.
Okay, thank you very much. Next question from Graham. When does the new business rates relief start from?
Good question. Let me just check that, because I did have that in my notes. So annual threshold for rates relief, it will be impacted from April next year. So yeah, unfortunately nothing at the moment, but in the next financial year, April 17, this is where they're trying to phase people out of, well, small businesses out of rates, paying rates basically.
Okay, thank you very much. Thank you for those questions. I'm sure there are lots more there that you want to ask Simon about, so he's got his contact details on the screen for you now. I'll also be sending out a copy of Simon's presentation to you all as soon as possible. So thank you all for joining us, and we hope you can join us again for our webinar, same time next week. Thank you again, Simon.
Okay, thanks everyone.